Well, there's been a lot of talk lately about silver failing as a hedge, especially after one buyer watched a painful paper loss show up almost immediately after buying near the top. So, in this video, we're going to separate a bad decision from a bad thesis, and you are going to walk away with a much clearer idea of what actually went wrong, what did not go wrong, and how not to repeat the same mistake. Because that distinction matters. A lot. Today is Monday, May 18th, in New York time. Drop the day and date you're watching from in the comments. And if you value my content, support me by subscribing and commenting, Our John AG. So, did silver fail this buyer, or did this buyer misunderstand what silver was supposed to do? Now, the story itself is not complicated. Someone bought silver during a moment of extreme excitement. Prices had been ripping higher. People were talking like every dip was gone forever. The emotional temperature was very high. Then silver reversed hard, and the buyer looked at the account value, looked at the price chart, and basically said, "This is not a hedge. This is a disaster." I understand that reaction. I really do. When you buy something believing it will protect you, and the first thing it does is hit you with a large loss, it feels personal. But here's the first thing we need to get straight. A hedge is not magic. A hedge does not guarantee that the price moves in your favor the day after you buy it. A hedge does not cancel out bad timing. And a hedge definitely does not become safer just because everybody online suddenly sounds convinced that it can only go up. That is where this entire situation starts to break apart. Let's take the emotional part out for a moment. If someone buys silver after a long, almost vertical move, they are no longer just buying a metal. They are also buying the crowd's excitement, the panic of missing out, the belief that speed itself proves safety. And that is a dangerous package. Markets have a way of punishing that exact mindset. Not always immediately, but when they do, it happens fast. From recent market updates, silver's late January run became extremely stretched before the reversal hit. It pushed far above levels that had already shocked investors only weeks earlier, then dropped violently as the market reset. The sell-off was not some ordinary little pullback. It was the kind of move that reminds people silver can behave very differently from gold. Gold can be emotional too, obviously, but silver has a smaller market, more industrial sensitivity, and a long history of sharper swings. And this is where the frustrated buyer's complaint becomes understandable, but not fully convincing. If someone bought near an overheated peak and then judged the entire metal within days, they are not really testing whether silver can preserve purchasing power over time. They are testing whether a hot market can stay hot forever. Those are two completely different questions. Now, silver supporters do have real points. Based on recently published numbers, the market is still expected to run a supply deficit this year, and that would mark another consecutive year where demand exceeds fresh supply. On top of that, a very large amount of inventory has already been pulled down over the past several years. That matters. It does not mean the price must rise every week, but it does mean the broader supply picture is not imaginary. At the same time, we have to be careful. Some people only talk about the bullish side and leave out the rest. The newest industry outlooks also show softer demand in jewelry, silverware, and parts of manufacturing. Solar still uses silver, but researchers and producers keep working to reduce that dependence or swap in cheaper materials. That is not some fatal bearish signal. It is simply part of the real market. So, when someone says silver has strong fundamentals, fine, that can be true. But when they silently turn that into silver cannot fall hard, that is not analysis anymore. That is overconfidence dressed up as conviction. There is also a second layer here that a lot of newer buyers miss. Silver is pulled by more than one force at once. It is partly a monetary metal. It is partly an industrial input. It can benefit when investors worry about inflation, currency weakness, or geopolitical stress. It can also get hit when the dollar strengthens, when rate expectations shift, or when leveraged traders are forced to reduce risk. That mixed identity is one reason silver can look brilliant one month and brutal the next. We saw that very clearly during the big reversal. Higher margin requirements in the futures market came in after volatility exploded. That matters because when traders need more collateral to hold positions, some positions get cut. When a crowded market is already leaning one way, that kind of pressure can accelerate a move that was probably vulnerable anyway. The crash was not caused by one single factor. It was a stack of pressures landing on a market that had become too heated. And I want to challenge one idea that gets repeated too easily. Some people want a single villain, one company, one institution, one neat explanation. But markets usually do not work that way. This reversal looks more like a collision of crowded positioning, profit-taking, shifting expectations around rates and the dollar, and tighter risk controls after volatility surged. Now let's talk about the word hedge, because this is where many investors talk past each other. If you buy silver expecting it to protect you from every short-term price decline, then yes, you are going to be disappointed. That is not a sensible expectation. If you buy silver as one piece of a broader attempt to hold real assets outside purely paper claims over a long period, then that is a different conversation. The time horizon changes everything. Imagine buying homeowners insurance and getting upset because the policy did not make your home rise in value the next morning. That would be the wrong test. Insurance is not supposed to feel exciting every day. It is supposed to have a role. Silver is not literally insurance, of course, but for many holders, the mindset is closer to that than to chasing a momentum stock. The purpose is resilience, not constant adrenaline. That is why buying strategy matters so much. The person in this story did not just buy silver. He concentrated his timing risk. He stepped in after a dramatic run, at a moment when emotion was doing much of the driving, and then expected immediate validation. That is how people turn a long-term idea into a short-term trap. The simplest way to reduce that risk is also the least glamorous. Spread purchases out. Buy in smaller amounts over time. Keep some cash available. Do not treat every rally as your last chance. Do not let a social media wave dictate your entry price. Dollar cost averaging is not perfect. Nothing is. But it helps prevent one bad day from defining your whole position. And there is another practical point here. If the size of your purchase is large enough that a sharp pullback ruins your sleep, the position may be too large for your temperament. I know that sounds obvious, but people ignore it all the time. They claim to have a long-term thesis, then build a position that only works emotionally if the price immediately rises. That is not patience. That is hidden leverage without the margin loan. According to the latest publicly available filings and market updates, silver's physical picture remains tighter than it was in more comfortable years. But liquidity has also improved compared with the worst moments of the prior squeeze. That combination matters. It means there are still reasons for long-term interest, while also reminding us that panic language can get exaggerated. Tight does not mean unavailable. Deficit does not mean straight-line price action. Volatility does not automatically mean manipulation. That is also why the latest vault and inventory discussion matters. Large pools of metal still exist, but what matters for stress is how much is actually available to move when demand surges. Recent updates suggest liquidity has improved from the tightest phase, yet the market can still become strained again if investment demand returns quickly while physical flows tighten at the same time again. Now, let's bring in the macro backdrop because it matters. Inflation in the United States has recently been running in the high threes, while benchmark rates have stayed in the mid-threes. Savers still feel squeezed. Borrowing is not cheap. Energy has been a pressure point. Global conflict has not disappeared. Those ingredients can support interest in precious metals while also creating violent swings as traders constantly reprice the outlook. So, if your entire silver case rests on one emotional sentence like, inflation is high, therefore silver must go up today, you are building on a weak foundation. Markets do not move in a straight line from cause to price. They move through expectations, positioning, liquidity, and sometimes pure exhaustion. Now let me say something that may sound almost too basic, but it is important. Paper losses are painful, but they are not the same as realized losses. If you bought high and the price fell, you have a problem. Let's not pretend otherwise. But the final outcome depends on what you own, why you own it, how much you own, and whether you sell in panic. Entry price matters. Exit price matters too. Both belong in the conversation. That is why I do not like the extreme versions of either argument. I do not like silver can never fail. That is nonsense. It can absolutely disappoint you for long stretches. But I also do not like silver failed because one buyer bought at a euphoric moment and immediately went underwater. That is too shallow. It confuses a timing error with a full verdict on the asset. If you're successful, share your success story in the comments so others can stay motivated. There is a reason experienced holders talk so much about discipline. If you were buying gradually before the frenzy, your situation looks very different from someone who arrived only after headlines turned breathless. If you held a balanced allocation rather than going all in, the drop hurt less. If you understood silver's industrial side and monetary side can pull in different directions, the decline was less shocking. Preparation changes the emotional outcome. Silver should not be the center of everyone's financial life. That would be irresponsible. Silver can play a role. Gold can play a role. Cash and productive assets can play roles too. The point is not to worship one asset. It is to understand what each one can do and what it cannot do. Silver is not a savings account. It is not a guaranteed inflation coupon. It is a volatile real asset. Gold tends to behave with more maturity. Silver often behaves like gold's energetic younger cousin who had too much coffee. It can outperform dramatically during certain phases, and then it can fall harder when positioning unwinds. That personality is not new. It is part of what you sign up for when you buy it. And this is why the recent crash, while painful, should not have been unimaginable. When prices rise too far too quickly, they attract momentum money. Momentum money is fast coming in and fast going out. Once the direction changes, the same enthusiasm that lifted the price can reverse into a rush for the exits. That is not a moral judgment. That is market structure. There is also something else newer buyers should know. A strong long-term thesis can coexist with a poor short-term setup. Those two ideas do not contradict each other. You can believe silver remains interesting over years, while also saying buying after a blow-off move was reckless. In fact, if you truly respect the metal, you should be more careful about the price you pay, not less. This is why I keep coming back to the same point. The biggest mistake was not buying silver. The biggest mistake was buying a story without respecting the cycle. Silver had already delivered a huge move. Sentiment was hot, headlines were loud, volatility was expanding, and at that exact moment, the buyer expected safety. Even a good idea can punish you if you enter at the wrong moment with the wrong expectations. After making that kind of mistake, the first step is not making it worse with emotional decisions. Revisit the original reason for owning the asset. Review position size honestly. Decide whether the holding still fits a long-term plan instead of reacting to the last ugly candle on a chart. And for everyone watching who has not made that mistake, learn from it before you pay tuition. Be skeptical when excitement becomes certainty. Be careful when price speed becomes the main argument. Be wary when people tell you risk has disappeared. Risk is often highest precisely when the crowd feels most comfortable. Putting this all together, silver did not magically become useless because one buyer chased a vertical move and got punished. But silver also does not deserve blind loyalty. The mature view sits in the middle. Silver can remain strategically interesting, especially if physical demand strengthens again. It can benefit from a world that feels inflation-sensitive and unstable. And it can still punish late buyers with savage drawdowns. That is the real message here. Respect the thesis, but respect the price too. Respect the asset, but respect volatility even more. A hedge is supposed to reduce certain risks over time. It is not supposed to rescue a rushed decision made at peak excitement. So, at the end of the day, do you think the bigger mistake was trusting silver too much, or buying it at the worst possible moment? Thank you for watching. Subscribe if this kind of calm, clear breakdown helps you cut through the noise. And just to be clear, this video is for education and perspective only. It is not personal financial advice or a recommendation to buy, sell, or hold any metal. Make decisions that fit your own goals, timeline, and risk tolerance.